We're now going to take a look at how we actually fund some of these projects. So I'd like to introduce our next speakers. We have two speakers. We have Elizabeth Johnson and we have Namrata Verma. Namrata Verma is financial advisor with Terrafranca Advisory Limited. Elizabeth Johnson works for Pimlico Advisory. And they're going to be looking at accessing capital to fund growth. Over to you.
Thank you very much, and good morning, everyone. I'm Elizabeth Johnson, and with my colleague Namrata, we're going to talk you through some of the options available for accessing capital to fund growth. Haven't done this before, so we'll see. So a short bio on both of us. I basically have over 10 years experience funding companies, predominantly London-listed companies, but they have spanned everything from exploration all the way through development and production. And Namrata?
And my background is more on mining finance and really on development assets, but I'm going to talk a little bit about how some of those funding structures are available for certain early stage and exploration companies. So traditionally early stage funding was considered equity risk, and debt or structured finance would come in more towards the development assets. In terms of equity sources for exploration companies, for private companies, the options were more limited to friends and families, high net worth individuals, and private equity is increasingly playing an important role there. For public companies, the options are broader. You can access the retail market, institutional investors, and also some high net worth individuals who would invest in that space. Now, post the financial crash, there was a brief rally. Okay. Oh, is it too loud?
No, you've got to be off the camera if it's bring to one side.
Understood, sorry. So post the financial crash, there was a brief rally in mining stocks, but by 2012, funding exploration was very difficult. And the tail of junior mining companies on TSX, ASX, and AIM, they really suffered. A lot of them, just to survive, changed into other industries. They went into tech in some other sectors. So that is sort of when other sources of financing like structured equity, convertible notes became more prevalent. And alternative funding saw a sort of revival for early stage companies. Royalties and metal streams, especially financed by credit funds and PE funds, started becoming available for early mining for exploration and early stage companies. They are obviously non-dilutive. They have an impact on the economics of the project or the discovery, but they were able to sustain the companies when the equity markets were closed. So we think the equity markets are coming back into balance now, and equity is coming back center stage for exploration companies, and the alternative financing routes are focusing more on development projects, but still for the right asset and the right commodity, I think these alternative options are available in some measure for early stage projects. So Elizabeth's going to talk a bit more about the equity financing opportunities, and then I'll talk a little bit more about the alternative financing.
Thanks, Namrata. So what's available on the equity side? There are obviously various options, all of which I'm sure you're very familiar with. The last 10 years, as Namrata, and as we've heard this morning, have been a bit of a roller coaster ever since the GFC, when everyone wondered if there would be a world tomorrow, back to the sort of rebound, and then suddenly financing drying up completely, especially for early stage companies. People have had to get a lot more inventive and imaginative when it comes to financing. Starting on the left-hand side, we have the obvious straight equity, which is what traditionally we have done. You can either issue it as sweat equity for private companies. As we've heard, attracting treasure hunters is key. So giving them something when you can't perhaps be able to afford the massive salaries they might like. Giving them a stake in the company is a fantastic start. Straight equity, obviously, for public companies, when you want to list, allows you to access a much broader and wider number of opportunities. Looking down the list, you've got your institutions, your hedge funds, your wealth fund managers, and private client brokers. I think one of the key things here when it comes to listing, once you've gone through the private stage, and using your equity properly, is to ensure you've got a balance on your share register. I know from experience that when it comes to financing companies, it's very stressful. Generally speaking, especially with exploration companies, you've raised just as much as you can to get your drilling campaign or exploration budget funded. You spend it, you suddenly realise you haven't got a huge amount left, you've got to come back to the market, and you don't really mind where that money's coming from, as long as it's legal, obviously. You are just really concentrating on getting it in. One of the problems from my side of the fence as an ex-broker is you want to have a balance so that once you've raised the money, those shares are going to perform well. If, for example, you're looking to raise 10 million and you have 4 institutions or 5 institutions who all want to put £2 million in, that's fantastic news for you. You've got the money, you're done. But afterwards, none of them are likely to sell if they're all long-term holders, and it means that the share price could just stay where it is. So getting a balance and ensuring you've got a mix of the larger holders and the smaller holders, more of the retail holders, will make sure that your shares perform as you would like, hopefully, if you manage to discover what you're looking for, in the right way, and your share price moves up without any of the issues such as liquidity, no liquidity in your shares, as highlighted below. One of the challenges for issuing equity, obviously, other challenges, is dilution. No one likes to be diluted. It's not a problem, I might add, if the share price goes up. But it can be an issue if you don't find necessarily, you don't strike gold on your first campaign and you have to come back to the market. People get a bit twitchy about that. Moving on, you have warrants and options. Warrants more common in the Canadian market, I find, than in London, but they have, especially over the last 6 years when funding for junior companies was very hard, been used as an incentive. The good thing about both is that assuming the share price goes up and hits their strike price, you do get more money coming in later on. The bad thing, obviously, is potential volatility in the share price. You can have extra shares coming in, especially if there's not much liquidity in your shares. And you are reliant on actually discovering what you're looking for. Finally, alternative finance or convertible notes. These became very, very popular when traditional sources of equity dried up, when the institutions decided that exploration was too high risk and they fell back and they were struggling even to hold some of the majors and were focusing totally on other sectors. Convertible loan notes for many junior companies were the only way they managed to stay alive. Now, they had a time and a place. I have to say I'm not their biggest fan, and their reputation or perception in the market has got worse and worse. They essentially, in many cases, enabled a fund to take a large chunk of shares up front, and then the money was issued at various stages going forward. They would exercise their convertible loan note, and the price that they paid was based on a VWAP. If they, dare I say it, there were ways the market, you could see the share price drifting in the days before they converted, which was never great. So a lot of the traditional investors saw it as basically a cap on the share price, and you would get no further. However, as I said, if it was a situation where you were looking at either going bust because you had no capital at all and couldn't fund your exploration campaign, or taking the money, you can understand why people went for the money. I think that's probably yes. There are various other issues with alternative finance, you have to read the small print very, very carefully. Quite often they took a large fee in shares, which, because it was their fee, they'd sell immediately, so you got a bit of a slump in the share price. And they also used to take warrants as well, so there were additional potential dilution further on. Looking at a case study for equity finance, Bushveld Minerals is one of my old clients. I chose it partly because they, as you can see, running through the timescale, they use a number of different sources of funding to finance a deal, which saw them turn from an exploration company to a producer. It was a deal when they announced it back in May 2016. If I set the scene, they were a junior mining company. They had tin exploration, vanadium exploration, and a coal power project in Madagascar. All their projects were in, other projects were in South Africa. They were sort of bumbling along on the market. Most people weren't entirely sure what vanadium was. Tin was getting a bit hotter, and coal was sort of, well, not doing a huge amount at that point. They had spotted an opportunity in the vanadium market. They believed that although prices were an absolute low then, they could see a supply shortage coming in and potential demand, especially from vanadium redox flow batteries, coming in the longer term. And they struck a deal to acquire Evraz's interest in the Vametco producing mine with the processing plant attached. When they struck the deal, they were set to pay 17.2 million in 2 tranches, so a smaller payment up front, the larger payment towards the back end. They then, a month later, struck a deal with a partner who came in to help them fund that initial, the initial phase. They then went back to Evraz and renegotiated that deal, brought the total consideration down, but it was due to be payable in a single tranche. So they had to go away as a management team and work out how they were going to come up with the 16.2 million. As I said at the time, the market was a little bit blur when it came to vanadium. They weren't entirely sure, most people weren't entirely sure what it was used for. It's a minority metal. It's very hard to see what the price is. And while they were interested and liked the sound of the deal, given that it was going to give them a producing asset, it was fairly lukewarm reception. So they had to raise a little bit of money to fund working capital. So they came, and as I always say, if you can see working capital requirements, raise a bit, hope that you complete enough of the deal so that you can show some progress, the share price goes up and you can raise some more. They did that, the share price went down a little bit, but not dramatically so. They managed to sustain themselves until in March 2017 they were able to announce they had completed their financing for this acquisition. The financing, the market couldn't see where it was going to come from. They structured as a sales and product agreement with Wogan, the trading house, and they got a bridge loan facility and an inventory finance facility from the Barrack Fund. And Namrata will run through these options more a little later on. So by April 2017, they had completed the acquisition. And again, the market was a little bit like, really? You've managed to buy a producing asset which has been profitable throughout the downturn for 16 million, just over $16 million. Wow. We'd like to see if it continues to produce as it has. It did. The way they'd structured the deal meant that they were able to pay off that bridge loan within 3 months. And by September, while the institutions in London were starting to get really quite interested in this because they could see the cash flow coming through, they wanted to see a couple of quarters from the management under their belt. So they came back to the market and issued 8 million in unsecured convertible bonds to Atlas Capital Markets. Now, as I said before, I'm not overly fond of these convertible loan notes. However, they do have a time and place. And they enabled Bushveld to continue their expansion plans, which they had announced when they completed the acquisition, which would see them almost double production within 3 years. By the end of that year, they had bought out their partner, Yellow Dragon, so they now own the 78.8% in the company owning Vametco. And in March, earlier this year, the institutional market in London had decided that they could see this was a fantastic deal and that management were able to run the mine as they said they had. It did help, as we heard earlier, vanadium prices have done very, very well. So having gone from an absolute low, they were soaring through the roof. And so their profitability was just going up and up and up. They raised 22.2 million in equity, straight equity. That was a deal which was very, very heavily oversubscribed. We had to upscale it, and then even then we had to scale investors back. But it had an excellent mix. We brought on 3 or 4 new institutions, as well as maintaining the balance, as I mentioned earlier, with some of the more retail, smaller holders, so that you maintain the liquidity. And I'm pleased to say that since the funds they raised, they were using to simplify their corporate structure as well as continue with that expansion program. They have simplified the corporate structure. So they now own 78%, as much as you can of a South African mine. 76%, I think, is in total. And their expansion plan is going ahead as they wanted. The shares have, as you can imagine, done incredibly well. They are up. If I say when they started the deal, share price was trading around 2p. They're now, when I last looked, were trading around 27, 28p. So for those that got in early, it has been a fantastic investment. But it is, I think, a very good example of how you can use the market and different options of financing to get you where you want to be. On which note, I will hand over to Namrata to take you through some of the debt financing opportunities.
Thanks. So these options are really not for initial discovery. They'll come into play after there is some form of initial discovery, but all the way applicable until you have a DFS. That's really when the senior financing comes in, the banks, the credit funds. But there is a lot of expenditure that you have to put in from discovery to the feasibility, and some of these options may be available. I think royalties definitely have been around for a long time. Traditionally, a lot of the royalty houses like Anglo-Pacific or Sandstorm, they were buying secondary royalties from founding members or management who'd earned them as part of the discovery. But increasingly, they are available as a primary source of funding once there is some discovery. Now, the good thing with royalties is it's applicable on revenue. You don't have any dilution for shareholders. You can structure it across commodities. It doesn't favor specific class of metals. The one challenge that one has to be very careful of is the jurisdiction. Some jurisdictions allow a true royalty to be placed where the royalty is attached to the mining property and it survives the sale of assets and survives bankruptcies. So that is really what a lot of the royalty investors will look for. A good example of that is Canada. And I did some advisory work for a company which holds a royalty with a polymetallic mine in Northern Ontario called Caribou Mine, which since they bought the royalty back in the 90s has gone through 5 sales and 2 bankruptcies. And finally was developed by Trevally Mining, which is quite strongly supported by Glencore. And the investor had to take it to the courts, and the courts awarded that in Canada, the royalty is attached to the mining license, to the mining property, and it survived the 20 years that it took through the 5 change of hands and bankruptcies, and Trevally has to pay that royalty. That may not be available in every jurisdiction. So one example is Spain. Again, there the government does not see the royalty as a right attached to the mining license, and so the investor might want to take security. So it is really more of a synthetic royalty. It will be priced higher, and it hasn't been tested in the legal system. Metal streaming is another option. It's a little bit of a mix between debt and royalty. Again, these are increasingly, for small amounts, they are increasingly available before feasibility studies are completed, early stage project development. You essentially get a payment upfront and you agree to sell your metal or a percentage of your metal at a predetermined price. This usually makes people nervous because if you are still 6-7 years away from production, you don't want to commit to a stream of, say, $400 per ounce in gold if you're a gold bull. But there are mechanisms to structure it such that it is based on a percentage of prevailing gold price, that there are ways that you can renegotiate it when you come closer to production. The challenge here is not so much of the legal issues that you have with royalty, but the challenge with metal streaming is it does sit as an obligation on your balance sheet, and they will have some rights to enforce their the credit. They will sit as creditors in case you're in an insolvency enforcement scenario. Offtake financing and prepayments are sort of in the same family. Prepayment is a bit of a subset of offtake financing, usually comes from the end user. These are, again, these are closer to project development. Really, if you look at these 4 products, it's in that timeline of just initial discovery, but before feasibility, they are available a little later in stage. Offtake financing is really any kind of structured financing that an offtaker will provide in order to secure the offtake, and this is really useful if you've got a specialty metal, not base metals, and gold is not really where this plays, but if you've got a niobium mine and a chromite mine and uranium, something which is specialized, doesn't have a big market, and or when you have users who want to fill up smelting capacity, refining capacity, they really are looking to put equity, alternative financing, some foothold in so that they get a chance to take the offtake. And they are increasingly ready to do this before they know the project metrics, and sometimes it will have an option for them to increase their stake once your project's proved up. I just want to talk about a couple of examples to see how how much in advance you can do this. So you'll see Noron Resources, they got chromite project. Anglo-Pacific got a royalty in 2011 when it was an exploration asset. Obviously, this was probably not the plan, but the good thing is that it has taken quite a long time. Right now, they're expecting first production somewhere in about 7 years. They're in consultation with First Nations communities, and the royalty just sits there, so you don't have any pressure as the exploration company to repay that, or it doesn't affect your share price specifically. Probably not the best outcome for Anglo-Pacific. That's not what they were expecting, but that is the nature of the beast here. The second one is an interesting one. Sandstorm purchased that in 2009. It's a sliding scale royalty. It's 3% if the gold price is below $1,500 per ounce, and 5% if it is above $2,000 an ounce. The reason I want to talk about the Equinox one is because it has now, Ross Beatty is the chairman, the Arizona project is now in construction. They're expecting first gold pour end of this year. Sandstorm originally had a 17% metal stream agreement with Equinox Gold. With the changes and the development, the company was able to bring Sandstorm back to the table and renegotiate that 17% metal stream, which was quite a penal, hefty stream, into the sliding scale royalty and a convertible. So that is a good example that if an exploration company does enter into a royalty or stream, which may seem to be the only option at that time, but when you come closer to a project development and that does not really attract the right kind of financing, a lot of these companies want to see the project developed, so they would rather come to the table and renegotiate what they had agreed to at an early stage than not have the project financed and developed at all. And just the last one, well, a lot has changed on Berkeley Energy since we did the slides on Monday, and they are having some conversations with the government about permitting, and they've been put on trading hold right now, so I won't dwell too much on that, but yeah, this was another one where RCF purchased a 5 million royalty on uranium, so you can see it does have favors just outside base metals and precious metals as well. With that, I am going to hand over back to Elizabeth so she can put on her other hat as executive member of Women in Mining and tell you all more about that.
Thank you, Namrata. Very briefly, before we move on to Women in Mining, I do hope that we've given you a taste of the opportunities available for funding. It isn't just straight equity. There are other opportunities available. As Namrata said at the beginning, we are coming out of what has been a fairly dire time for funding junior exploration companies, and we hope to see more funding for them going forward. Moving on, switching hats to my Women in Mining hat. Very briefly, a few words on it. Women in Mining, we are a non-profit organisation. We're dedicated to promoting the employment, retention and advancement of women in the mining industry. We are delighted to partner with as many people as possible. If you are interested, do get in touch. It's free to join. It's open to men as well as women. We throw, dare I say it, some very good events. Our next event is actually on Thursday in partnership with the Beers. We have our top 100 inspirational women in mining being launched on the 15th of November, so please watch out for that. We do it every 2 years, and there are some leaflets in the next door room you can pick up at the coffee break, which will tell you a little bit more. We are on Twitter, we are on LinkedIn, and I believe we're also on Facebook, so do follow us, and if you want to hear more, come and have a chat with me. I'll be around for most of the day. Thank you very much.